today's event. I'm excited to introduce to you our very own Malcolm Geffen. He's an SBDC consultant here at the SBDC at the University of Laverne that helps businesses through this process, and every business is different. So I'd like to welcome Malcolm to the stage if we can. As I introduce him, he's got an established career as an entrepreneur with a strong background in professional management and corporate turnaround work. As an entrepreneur, he's founded, acquired, and run businesses for many companies in many different types of industries, both as an entrepreneur as well as doing corporate turnaround work for investors. And when he's not here at the SBDC or doing, you'll find him in South Orange County running a team of 12 CEOs in a forum that he leads, and really just being an advocate to small businesses in general. And we can't thank you enough for taking time to join us on our Q&A portion of our broadcast today. Welcome, the man, the myth, the legend, Malcolm Geffen.
I don't think I'm going to acknowledge any of that, but thank you for asking me to be here.
Well, it's a pleasure to have you both on the line. Between the two of you, we have a lot of good experience, and I'm excited to start to feed in some questions that we've been receiving since we started our broadcast. And first up, we have a question. I liked your example in the slides, Ed, but we have a question. Do you have any tips for purchasing a fast food restaurant from Facebook?
Is it a franchise or would it be an independent business? You know, if it's a franchise, of course, you're buying two things. You're not only buying the business, you're buying the franchise, that relationship. So certainly that's a very important relationship there with the franchisor as well as the franchisee that you're buying it from. The other thing just with a restaurant is verifying your information. And again, a restaurant's a fun business, but it's a high burnout business. You can do something 24 hours a day in a restaurant. You just got to make sure that you're comfortable with it. And if you are, though, it'll make a good family living. And you can feed your kids there. You got to feed them anyway, so you just well feed them with retail, if not wholesale. Wholesale rather than retail.
Anything to add, Malcolm Geffen?
Well, a couple of things. I think the hard part about buying restaurants, particularly something like the fast food restaurant, is substantiating revenue and expenses. So the benefit of buying a franchise unit is that the franchisor requires specific details, and they monitor the performance of the franchise, because obviously that's where their revenue comes from. So that's step one, and they're the people who can also jump on things where expenses aren't particularly good, and they set boundaries and parameters. I'm not crazy about franchises, but I think that's one of the benefits. The other thing is when you're buying a franchise of a fast food restaurant, sales tax returns are really important, and most states, I assume, certainly the state of California, requires frequent and regular sales tax returns, and that's a good way to start looking at a franchise unit, at a fast food unit.
All right. Well, I've got another question that just came in. Same kind of question. Tips on buying a dental office business.
Obviously, you need to be a dentist.
I'm not always convinced.
Yeah. But most of the time, you've got a younger guy, a woman, and somebody else is retiring out the other side, and that transitions that customer base, you might say, in the relationships they've got there. And that reputation is very important. And oftentimes they'll work together for a while before and after the sale, with the person retiring, helping transition for 6 months or a year, somewhere along in there. It's critical to that.
Now, I think you brought up a good point. One of the questions we got was asset sale versus stock sale. Any thoughts on, well, describing the difference between? We'll start with that. And then, as you mentioned, with the license or being a dentist, a licensed dentist, how does that maybe influence asset sale versus stock sale?
Well, normally, you look at a stock sale. In small business, we don't normally do. Well over 99% of what we do is an asset sale. We don't buy liabilities. We don't buy corporate shares of stock because there's no definition of value about the open market is. Stock market opens in the morning, 10 o'clock, closes at 4, and whatever those shares trade for, that's the market value. And we don't have that opportunity in smaller business. So the shares, it may be a sale of the corporations, but it's a sale of the assets of that corporation, including the name. Usually when we do have a stock sale, Son, there's a reason for that. In other words, there are contracts in place. You don't want to violate those contracts between buyers and sellers. There may be some other obligation that's already up. It's a very valuable asset to continue relationship, and so you buy the stock. But you need to have, if you do buy the stock, you just bought all the liabilities that company had that you don't know about, and that's the concern. Usually, people don't want to buy the stock.
Well, let me just jump in because in small business, I'm always nervous about buying the stock of a corporation. And it doesn't relate necessarily to what the value of the stock is. It relates to what the overall value of the enterprise is. The problem is if you buy a stock of a corporation, you take over all assets and liabilities, whether disclosed or known or not. So you could very easily land up in a situation. Let's say you buy the stock of a construction company and they built a home and the home collapses 12 months time for reasons of defects in the construction. Even though you were not there, you land up with a responsibility for the collapse of it, and you're going to have to pay the penalties. So unless there are special circumstances, I always advise people to look for a sale of assets and maybe putting it into an LLC or into a new corporation which files taxes as a subchapter S corporation. The other thing is if you do an asset sale, it also allows you to reevaluate the value of assets. So if you bought a pizza parlor, for instance, and the pizza ovens are depreciated to $10,000, you can in fact look at stepping up the value of the pizza oven to, shall we say, $100,000, and then depreciating that over a 5-year period of time, which gives you some cash flow protection as well. So you'll be generating more cash, but you won't have to pay tax on it. There are obviously parameters and logic in it, but in general, unless there's a really good reason, which as Ed said, may relate to a contract with a specific company, which cannot be adapted. Other than that, I don't recommend buying the stock of a corporation.
It sounds like the asset sale gets you that clean breaking off point from the old to the new owners, and good feedback. Okay. The next question that we just had come in talks a little bit about breakup fees. They phrased it. If you're getting into the sale of that pizza parlor and you decide not to go with it, what are there any fees associated with it? Kind of like if you're in escrow and you back out.
I can tell you from a broker standpoint, we almost never have that situation. In other words, any offer you make is contingent on complete due diligence, review and approval of financial, review and approval of tax, or the terms of the lease and conditions. Landlord, we deal with a whole other set of negotiations there, so we're not sure what's going to happen. We want to make sure we protect ourselves through there. So we very, very seldom ever have a buyer forfeit that deposit based on because of due diligence. Now, once we've done all the due diligence and we've set everything up, we got the financials in place, there may be a point that deposit becomes hard. But I would say certainly about 95% of the time, if it doesn't work, the buyer gets his deposit back.
Well, let me just add to that because I agree with Ed that if you're going through an escrow or some sort of variation of that part of it is you can walk away at any point if there are errors or omissions or issues in what you've been provided. But I have been in deals where there is a breakup fee if in fact it all complies with the instruction, and at the end of it, you decide that, well, I just don't want to do the deal, and you want to walk away. Plus, it's also very important when you write the escrow instructions that you point out clearly. I mean, if the offer is subject to financing, that's a contingency that has to be removed. If you don't do that, and you say, I have the money, you could quite easily be hit with a breakup fee. That's my contribution.
Ed, did you have something else you wanted to add? Or we got another question here.
No, I think the occasion where we've had a breakup fees, like you said, Malcolm talked about, we go all the way down the road and everything kind of is prepared to close, and for whatever reason to buy a backside, then it should be an instruction that what would happen to that deposit based on that. Most of our buyers universally have, I'd say, $50,000 to $150,000 they could put down on a business, small business. It's on the. I always say that Americans not big savers. We make 100,000 a year, we spend 110. We make 200, we spend 210. Now, I will tell you, if you ever make 300,000, you become a Republican. And Republicans can always save money. See, so you have to look at how that comes into play with the deposit.
I'm not going to touch that line at all.
Well, our next question is about leases. Is it better to negotiate a new lease or have the lease assigned? That's probably it depends question, maybe I would answer.
Almost always from a lease standpoint, subject to doing that. Most of the time, the landlord will work with you on the transition, want somebody to stay and pay, particularly in today's time. They ended up with a lot of office space and things that are open space and retail space that aren't running that. So hopefully they'll work with you on the transition. They want a good tenant to stay and pay, and hopefully won't kill your deal, which a landlord can do by giving us a lease the buyer can live with.
Well, let me come in at it, and I agree with Ed, but with a slightly different focus. It depends, A, on the length of the lease, and B, on the term of the lease and the financial conditions on it. Most leases should have a clause in it which says something to the effect that it's subject to landlord consent, which consent may not be unreasonably withheld. If you're looking at a lease that has got 2 years to go, then you really do want to renegotiate the whole lease. If you're looking at a 10-year lease and the economic terms are very favorable, then you really want to take over that lease and have it assigned. And the probability is the landlord isn't going to want to do that because he thinks he can get more rent. But that's where the unreasonably withheld piece has some validity.